The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, let's take a look at how the market trade wrapped up on Wednesdays. I'm spending time inside the USDA right now. Joining us from his office in Kansas, Mike Zuzolo with Global Commodity Analytics. Mike, it is good to talk with you, my friend. I'm currently was listening to a USDA briefing here, and of course, they had their WASDE report on Tuesday, and tariffs were part of that report. I know that's going to be part of our conversation here today as well. I'll just say the caveat is if you hear clapping in the background of my microphone, there is stuff going on in the wall behind me. But Mike, good to have you on the show today. Hope all's well.
Yeah, good to be back with you, Jesse, and thanks for having me, even though you're on the road.
Absolutely. Well, let's start and let's dive into this conversation, talk midweek markets. And I think, the biggest thing, Mike, is that markets have just been volatile lately with the tariffs. Are they on? Are they off? What's going on? And it just feels like that's kind of been the theme. And that WASDE report didn't really give us anything fresh, it seemed. The markets are just kind of playing off the headlines still.
I agree. And, you could have taken the USDA numbers two ways, didn't feed the bull or didn't feed the bear. I took it the second way. I didn't think it fed the bear at all, in that USDA didn't change anything but wheat exports by 15 million bushels for the current marketing year. Now, as a side note, Jesse, I think that fits really well into the history of tariffs. My plan of action and analysis continues to be I'm going to give President Trump and all of our major trade partners about 100 days, his first 100 days. He's about halfway through that, to get everything back in a straight format and back in an easing trade mindset and get off the tariff kick for the world. If that doesn't happen, I think that bodes very poorly potentially for 26, 27, and 28. And so I'm less worried about 2025 because of tight stocks, because of some weather we'll talk about a little bit, but also especially because historically tariffs, once they get started, it's hard to unwind them, and it really starts to eat into the global economy, and recessionary fears build. Commodity demand goes down, your rationing demand, that kicks in later on. My mindset with the USDA not feeding the bear was that Russia was bombing Odessa. It took out a grain ship reportedly early in the morning this morning. Mm-hmm. And we also saw the wheat dryness come in a big way with our area and out west and south where the real hard red wheat country is. Looking at maybe record high temperatures being broken today and maybe even tomorrow before a cold front comes through. That's not going to generate much rain for the hard red wheat belt in the forecast. So my market mindset was we could follow on with the higher trade that we started out with, as long as the wheat and the dollar let us. These EU-Canadian tariff hits that came in on Wednesday, though, I think they really resurrected the fear, and the tariff bear came in. And we also saw the dollar start to shoot back up and see some short covering there. What looked to be maybe the beginnings of some safe haven buying in the dollar. So we're really in a tough spot right now with losing momentum, with March expiration in futures for grains going off on Friday.
Well, let's talk about some of these macro fundamentals tied in with things here. And let's start with the SRW chart and the ruble. And you mentioned some of this global economic tie-in here. So let's walk through this to start. I mean, what are you seeing when you compare our SRW futures against the Russian ruble?
Yeah, I see this chart suggesting, along with the weather in the southern plains and hard red wheat belt, that wheat is still our potential leader to the upside, because what you notice on the top chart, and that's the ruble against the dollar, which is inverted. So as the price goes up, it actually goes down in terms of value. And that inversion shows us that we made a 115 low in the ruble against the dollar. We are now at 87,146. That's a 30% gain in the ruble against the US dollar. And this is why I put the US dollar as such a key to the overarching tariff mindset and what the funds could possibly do. In other words, do they go net short more in beans, more in wheat, and turn net short in corn? I don't think they want to, unless the dollar starts to really come on and become, as I said a minute ago, more of that safe haven bid. One thing that's happened that's benefited us has been Wall Street has tanked. We're under a severe break in the downside, 10%, depending on whether you look at the S&P or Dow Jones futures. That also has weakened the dollar. And so when I saw the European tariffs come on board, Jesse, we do sell a lot of soybeans, a lot of ethanol, and a lot of corn to the EU, and the increases over the last 5 to 10 years have been pretty steady and very healthy. Compare that to the beef, and they're number 8 of our top 10 beef buyers in dollar terms. And I know I'm mixing it up a little bit here, but this helps explain why the cattle market didn't get caught up as much, I think, as the grains did when the EU and Canadian tariffs started to kick into high gear. And obviously, if we lose pigs coming from Canada into the U.S. system, that's going to mean we're going to have less pork to compete with beef. So I think the cattle market made a lot of sense today. The grain market made a lot of sense if you buy into the idea that this tariff hit by the EU and Canada started to resurrect those fears from last week.
Well, and I should have mentioned this at the top. Kind of the theme today is tariffs in the eye of the beholder. And I think it varies, to your point, by market here, market dynamics. You mentioned the EU. Walk me through what you're seeing with the U.S. corn versus the Paris corn spread. And then I think that's going to parlay us into looking at SRW versus corn. But what are you seeing here between these two on the corn side?
You know, a very similar chart as what we just looked at. We've already got the ruble up 30% off its lows. Here we've got Paris corn trading 25% higher in dollar terms versus the CME futures. So that says to me, the funds are already putting in a 25% tariff at this point. We don't need to go any lower in CME corn futures unless Paris goes down or unless the tariffs change. Now, that's not the case when it comes to Gulf of Mexico corn against what the European corn price is on the Rhone River in France. We're only about 9-10% cheaper than Rhone France spot cash bids right now. But you notice that these funds are working the idea of pricing in the tariffs already to the futures. And this helps explain why we're still dealing with the 530 to 550 cash corn price at the Gulf of Mexico, while the futures is getting close to $1 discount. We're at 75 to 80 cents discount now, getting very wide in that discount in the lead month futures as March goes off the board. And that's why I'm bringing this up again, is we've got a big discount against some other key players out there. Can March turn it around here as it expires?
How about that SRW corn spread? Let's take a look here and hone in on this. What does this chart tell you, Mike?
You know, this chart's wedging. The white wedge is looking like it's going to want to break out. The fundamentals would suggest we could go back up to the false breakout to the downside in the green wedge. And why I say that is because this wheat dryness looks for real the next 14 to 20 days in the southern plains and western corn belt, i.e. Kansas and Nebraska and parts of South Dakota, Jesse. And the other thing it goes back to is what we've been talking about with the ruble and the lack of competition in the wheat. And I think we're still losing bushels in the Black Sea. India's going to have a good crop. Australia is going to have a good crop. But I think Argentina, the U.S., and the Black Sea, not so much. In fact, one of the European privates came out just on Wednesday and said the exports out of the European Union for wheat are going to be at a 100-year low, a century low. So the idea that this spread could go from the current 88 cents, 90 cents, this was all midday chart price action that I put up here for you before the close. But the idea that we could go from 88, 90 cents back up to that 180 point or pennant where that wedge comes together from the green wedge, it would not surprise me, because then you'd get back up into an area where wheat is again a food grain and not competing as a feed grain with corn.
Spring weather's right around the corner, and we should touch on this. And you have some charts and research looking at Champaign, Illinois, of course, key I-state. And just thinking about, as we're getting ready to start rolling planters, the U.S. weather conversation is going to become a very big deal here in short order, isn't it, Mike?
Yeah, it really is. And I think this is how I would look at it right now, Jesse, is if we stay dry in the Western Corn Belt and hard red wheat belt, but the three big I states get rain. And that's one of the things that did change on the models on Wednesday. There's a pretty good system coming across the next 5 to 6 days that could hit most of Iowa and give them an inch and a half widespread drink. That's very sorely needed for the state of Iowa right now. So if the three I states get rains and Ohio gets some rains, and that's what the March, April, and even to a lesser degree the May forecast here, what I call the trade model for the springtime, is accurate, it would make sense to me that this market could want to go back down into the downside if we don't find support right away after the March expires, and maybe try and go after a double bottom after last Tuesday's shock tariff lows were put into place. And then if we stay dry in the Western Corn Belt, we start to rebuild from the idea that, yes, we've gained corn acres, but we can take the 180 yield level nationally off the table for right now. So that's early days in this, but I'm already starting to talk to clients and subscribers about it.
And as we know, I mean, things could change. This could ebb and flow with the way the forecast goes, but it's interesting to watch some of these, at least early indicators, right, Mike?
I agree. And, right now I'm paying for 5 different models, Jesse, plus the work that my oldest brother taught me a long time ago. And some of the models that I'm buying right now are AI generated models. And I've even taken those out of the mix because they're new. I can't remember a time in the springtime in March where the models are in such agreement when you get out there way, way far out, 60, 90 days out. So that's why I'm taking extra note of them.
Mike Zuzalo with Global Commodity Analytics joining us here today on Market Talk. Let's take a look at the soybean continuation chart, then we'll talk some livestock to close things out today. What are you seeing in this soy complex? Obviously, a lot of different fundamentals going on there compared to corn and wheat right now.
Jesse, after the USDA report and seeing another decline in world ending stocks, and that takes us down 8% since the December report. We've lost 8% in world ending stocks since the December WASDE report. And these are big numbers. I mean, statistically speaking, that's way out of bounds for what USDA usually does. And so I would argue that we're still a question mark about what the final number is going to be for Brazil. But almost everybody I've talked to, and I just spoke with my South American colleague yesterday, it's going to be difficult to get us below a 165 Brazilian bean crop, even though Rio Grande do Sul is looking at a 30% loss in production this year. So 165, 170 still keeps us at a modern day record high global ending stocks number for soybeans, with Brazil now over the 60% harvested mark. That means the only real hurdle that we have to jump now is Brazil's logistics. And so we're really getting close to where China can take on a lot of Brazilian beans with or without us, and regardless of price, in case the tariffs get worse. So this chart I wanted to bring back because we've talked about it before. This chart goes all the way back to 1976. You notice how there's such a dynamic on those price lines of 840, 940, and 1040. Our current 2025 low, that's the last bar on this chart, is a lead month low of 978. I really don't want to take that out on a closing basis on Friday's expiration for March, because it makes it a lot more likely we're going to have to go down and retest the 2024 low just below 940. And if we take that out, then that support line in blue that is at an angle, the uptrending support line, looks like to be a viable candidate for something we may have to test with these kind of stocks levels. And if we don't get an agreement between the U.S. and China. Last I've heard, the negotiations are stuck at lower levels and they're talking past one another. So it's not a good situation right now, even though we've all heard China wants to work with us.
Let's switch over and talk livestock. It was a solid day in cattle, feeders leading the way. Live cattle, though, too, finding some good strength on the board. What are you seeing on the feeder fat spread? That's been something you and I have been tracking for quite some time. How are things looking there right now?
Yeah, what a nice seasonal move this is, and what a nice clean market we have in the fat cattle and the feeder cattle market. If you're a rancher right now, you've got really this market running on all eights as far as not being a confusing market like the grains are. You've got a new all-time high in that feeder fat spread that goes all the way back to the 2014 high, Jesse. If you close above that 78.48 area on a weekly close on Friday, you're in new territory. And this speaks very highly to the idea of the continuation of my forecast and expectation is that we very well could have a major fat cattle high and feeder cattle high in place by the time the April fat cattle go off the board. And so the feeders are still leading the fats higher. That 282.25 record high in feeder cattle is now very easily within reach after Wednesday's price action. We're still a long ways away from the 209 plus level in the cash fat or in the futures for fat cattle, but I did notice midday cash did come back in at about 201. So my mindset's very simple. Use this mini blizzard, use this negotiated cash support, and especially the fact that the hot cash market in the feeders has come back with the 317, 320 price being traded in the north this week. You've got a feeder cattle run that's helping the fat cattle. We need to take advantage of it here, I think, in the next 30 to 45 days.
And one more monthly feeder chart just to kind of illustrate your point here, just looking at a clean market. I mean, you could see it on this chart as well, Mike.
Yeah, and that yellow dotted support line, we've tested that. That's just probably, 7 or 8, maybe 9 months of price action. And we've tested that almost a half a dozen times. So I take that that dotted yellow line very seriously. And if we take that out, then we're probably going to have to go all the way back down towards the 250 level where that next trend line is.
I want to wrap up today, and I will tell you this, that I just heard in my USDA briefing here today with the Farm Bureau folks that Chief Economist Seth Meyers speaking, and he mentioned how they tried to factor in the tariff conversation into the March WASDE and said that they kind of just came to the consensus that they don't expect the tariffs to impact this crop year, the 24-25 crop year, but then some of the adjustments they made, they're looking ahead. So I think all of this kind of comes back to the theme of tariffs in the eye of the beholder. There's just so much right now to kind of take in, right, Mike?
Yeah, but the premium thing to keep in mind versus last week and what we've learned in the last 7-8 days is that dollar going down so sharply while the tariff threat was under us really helps solidify the funds to not want to jump on the short train too aggressively. And so I still put a lot of credence in that dollar. We do not want it to be a safe haven. And Jesse, look at the crude oil today. We jumped to a new weekly high on a stocks build. That doesn't bode well for the Russia-Ukraine peace accords, in my opinion. I think the trade's trying to price in Russia walking away and not doing a ceasefire. And if that would happen, that could easily, in my mind, put the dollar back into a safe haven bid.
Well, Mike, I was able to do the show without getting kicked out of the USDA today, so that's a good thing. If folks want to reach out to you for analysis, I know they can find you easily online. How can they get in touch, Mike?
Yeah, globalcomresearch.com is the website. You can take a look at some stuff and sign up for a free trial there, and it's globalcom with 2 M's, research.com.
Well, I'll head back in, see if I can get some more answers from the folks here at USDA on some burning questions I know a lot of our viewers and listeners want to know, and we will talk to you again next week. Mike Zuzolo, Global Commodity Analytics, thanks for joining us on Market Talk.
Thanks, Jesse. Good luck.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.